Welcome to Business 507, Week 5, Module 2, and our topic this week is life insurance. My personal opinion, after seeing many estates as I prepare estate tax forms, having financial difficulty in the liquidity area because of lack of cash, and welcome life insurance. My personal opinion is almost every estate needs a substantial amount of life insurance, and for various reasons. And before we get started on this, here is again what we talked about previous in this course: the estate liquidity. When a family member dies, there's cash needed, especially if it was a working member of the family. How do we get that cash immediately? We also have debts that have to be paid. Again, life insurance is the answer for all of these. And I find it very difficult to believe that anybody is in a position that they don't need life insurance in today's market, unless you're the super rich. But for the people who will be your clients, they will need life insurance. Candidates for life insurance, who we're concerned about, well, we again want to repeat what we've mentioned several times already in this course: the beneficiaries and charities. Our beneficiaries need something to carry them through during the time period while they're waiting for probate to go through. We have debts that have to be paid, and those debts, again, don't give you an extra year to pay it, or 2 or 3 till you're out of probate. No, they want to be paid right now. And then we have tax payments. And again, tax payments are due for income tax as we're going along on April 15th, and if it's an estate tax, 9 months after death. So there's a lot of need to have liquidity, and there are all needs for life insurance. The impact or incidence of life insurance ownership: if you retain any incidence of ownership in a life insurance policy on the death, the face value goes into the estate. Now, any incidence, as we go back to week 3, is very broad. The ability to change or add beneficiaries, the ability to borrow against the policy, the ability to change trustees if it's in a trust. Any of these will put the policy in life, this decedent's estate. You might also note that if it's transferred within 3 years of death as a gift to somebody else, it's going to go into the estate. So a lot of people will have it in their estate. I think that I've heard many advisors, and certainly most textbooks will tell you that the life insurance should be transferred to family members so that they can take care of lending money to the estate so that the policy isn't included in the estate. Frankly, I don't trust family members, and so I say, well, put it in the estate, and yes, we're going to have to pay a tax on the life insurance, but at least we know it's there. And let's face it, life insurance is relatively cheap. Let's see, the types of policies we can consider is group term, which is covered in your income tax course, as well as in your insurance course. Survivor life, which is covered in your insurance course. First to die, your insurance course. Key person, which is in your insurance course and also probably in your retirement course. And split dollar life. We're going to look a little bit at these, but again, I make the assumption that you've had these in your other courses, so we won't be going in a lot of depth. And you note that your textbook doesn't go in a lot of depth on it either, because again, the assumption is what you have in your other classes. Company group term insurance is extremely cheap. It's based on how old you are, and you're only taxed on the insurance premiums that are above $50,000. So if you have, say, a $100,000 policy, you're going to be taxed on $50,000, not on the $100,000. And again, it's very inexpensive depending on the age, and even if you're older, it's very inexpensive. The limits are few. You have to have 10 employees in the company or in order to have the term insurance, but other than that, it's very easy for your employer to put in. Survivor life insurance, generally known as the last to die insurance, is very important because it pays the death benefits when the last insured dies. In many cases, such as the use of financial planning in marital cases where the husband and wife agree to the use of the various ABC trusts. The first person who dies usually has zero or very minor taxes, but the second to die has very big taxes. So they need cash to pay that out. That's where the life insurance comes in. And finally, um, it does take care of that large tax bill if you plan it properly by having enough life insurance. The real difficulty, as we've talked about it before, is how much is going to be the estate tax when you die. We don't know what the threshold will be. We don't know what the tax rate will be, and we don't know when we're going to die. So I would say the best idea is to over-insure, be conservative in the area so that you minimize the risk. And also the overinsurance helps pay the tax on the life insurance that's being used. First to die life insurance is used for buy-sell agreements, and that's, again, business use, and married couples not taking full benefit of the marital deductions. In other words, there's some tax due on the first to die. Now, again, I hear people saying, well, it's $5 million index today for the estate tax. Well, we don't know what's going to be 2, 3, or 4 years from now. It might be down to $1 million, might even be as low as $600,000. And if it goes that low, that means a lot of people not planning today for estate tax will be stuck with it. So I, again, advise people to have a first-to-die life insurance policy if you're married and you're not transferring all your assets to the surviving spouse on a qualified basis, or you're using more of the bypass trust than is allowed by the annual unified credit, or by the unified credit rather. Key person life insurance. This is a policy owned by the company. It covers death of key employees. The employee does not benefit from this, and I had a client who came to me and he told me he had, I think it was $3 million with insurance, $2.5 million. That's a significant amount of insurance provided by his employer. Well, I didn't know employers were that nice, but he was the sales manager, so I didn't think about it. I was going to do a financial plan for him, so I asked for him to bring all his policies in and his trust and everything else he had so we could work on a financial plan. And when I got the insurance policy, it was a key employee policy. He wasn't even going to benefit from it. I asked him how he got a copy of the policy. He said, well, he knew the key employee policy was there, so he convinced the bookkeeper to give him a copy of the policy. And I think he was really shocked when he found out that the company got the money at his death. He didn't. The big advantage of the company, quite honestly, is it covers those costs of replacing key persons, or maybe having the money to carry the company while they're looking for a replacement, or the money needed to do some of the go work for the company. So it serves a number of purposes for companies. The policy and premiums are not tax deductible, but the life insurance policy is. However, if you're a corporation, like any other life insurance policy, it is included for purpose of ultimate minimum tax. Split dollar life insurance is used by companies for various purposes. The whole concept has the company has some benefit from it, and the employee has some benefit. It might be used for a life insurance policy for the individual if he dies before retirement, and at retirement it becomes a retirement plan. But that might also be where the company gets the proceeds if the individual dies during the period with the company, and then after he leaves the company, then it becomes an insurance policy. Again, lots of flexibility, lots of different uses depending on what the client is after. And I certainly think that for many companies this is important for recruiting executives, especially older executives who probably haven't thought a lot about retirement. Life insurance trust. Unfunded with only the life insurance and the trust is what we usually find, because it's the cheapest way to go, least expensive way to go. So the premiums have to be provided from outside the trust, which means that there is going to be a gift tax involved, because you don't get an annual exclusion. And it's called funded when life insurance and the asset that I use to pay the policy premiums are both in the trust. I have seen this in divorce cases where the spouse says that they're never going to get alimony payments, and at death they're not going to get anything. So part of the divorce settlement would be to have funded trust for purposes of providing the assets, the income for the individual during lifetime, and an insurance policy at death. And then any assets left after the death would go back to the heirs of the person who had to put up the policy. Complicated and expensive, but sometimes that's the only way you can get those divorces settled. But for the most part, you're going to find unfunded life insurance policies. And again, reminding you that when we talk about life insurance, funded and unfunded, it is not the same as when we talk about trust, funded and unfunded. An unfunded trust means there's no assets in it, and unfunded or a funded trust is one with assets in the trust, where life insurance trusts have the different definition we just talked about. The Crummy Power came from a court case and is very beneficial. What it basically does is allow for an annual exclusion to be used when you're putting money into a trust. And the way it works is a beneficiary has a non-cumulative right to withdraw annual contributions to the trust. And it's just, since they have that right, it allows for the donor to get an annual exclusion. It is a complicated situation. There's questions of general power, special powers appointment, etc. So again, it's some covered in your textbook, but basically you need an expert to work with you on this. That could be an attorney or a CPA, and crummy powers can be used for other than just insurance policies, but they're most common in insurance policies. That covers the topics we had from Module 2 of our Week 5, and we will be suggesting that you get into Module 3 relatively soon, because quite honestly all of these are interrelated, and you can remember it easier. And likewise, also remember you can go back and listen to these once more time.